copyright of this video belongs to CA Campus. Offenders will be prosecuted.
Hi, welcome to our revision lecture 1 of 2 on IAS 12. The key elements to understanding IAS 12 is that you need to understand the difference when we look at accounting profit versus your taxable profit, and then current tax versus deferred tax. Let's first have a look at our accounting profit. Your accounting profit will be your profit before tax disclosed in your profit and loss statement that is calculated based on your accounting rules, IFRS, compared to your taxable profit that will be based on your tax rules regulated by SARS. Now, how do we calculate our taxable profit? You need to keep in mind the following. We will have to take out our accounting rules and include our tax rules. Therefore, we divide this into either 1 exempt differences or 2 temporary differences. Now let's have a look at examples of these differences. The first set of examples will be when we look at our expenses recognized for accounting purposes but not recognized for tax purposes. And an example can be fines paid, donations paid, depreciation on admin building. Now, what does it mean if it's recognized for accounting but not for tax purposes? If our profit before tax is, for example, 100,000, included in that profit is fines paid to the value of 10,000. And this is allowed for accounting purposes. Therefore, we can deduct this for accounting purposes, but we cannot deduct this for tax purposes. It's non-deductible. Therefore, we will have to add this back. If we add it back, positive 10,000 to be able to calculate our taxable profit. And then this will be 110,000. Therefore, it's allowed for accounting purposes, but not allowed for tax purposes. And this is the reason why I've indicated to you that we need to take out our accounting rules and we need to include our tax rules. Then let's have a look at the next example. This can be income not recognized for accounting but included under our tax laws. The third set will be expenses not recognized for accounting but included in our tax laws. This can be an example such as employee bonuses. Remember, employee bonuses we need to accrue for in terms of IAS 19. Now, we can only deduct an employee bonus when we actually pay the bonus. Therefore, we will have to add this back, the accrual, and then deduct the actual expense. Then we can have a look at certain income that is allowed for accounting but not for tax. This can be such as dividends received, a portion of capital profits on sale of assets, and important revenue earned in other countries. Now, I quickly want to discuss the portion relating to our capital. Let's say, for example, we've sold land. The cost of our land was 100,000. Our selling price is 120,000. Therefore, we recognize an accounting profit of 20,000. Do you agree with me that this accounting profit of 20,000 will be included in our profit before tax? Now, IAS 12 deems this portion of a capital nature. Therefore, we can only recognize 80% for tax purposes, and we need to take out 20%. We can only recognize 80%, therefore we have included the 100% of the 20,000, and therefore we will have to take out 20%. Now, what does this mean if we need to take it out? Remember, we've included the total 20,000, therefore we need to take out the 20%, and this will then be our profit for tax purposes. Then it's important to identify that your temporary differences will be the movement of your temporary differences in your deferred tax calculation. And I will explain this in detail during our class examples. Let's quickly have a look at the actual calculation of our current tax expense. We need to use our taxable profit calculated times the tax rate. And this will be the amount that will be payable to the regulatory body, SARS. Therefore, we will have to then debit our income tax in our profit and loss as it is an expense and credit our payable in our statement of financial position. Now let's have a look at the difference between current tax and deferred tax. It is important to understand that the calculation of current tax is regulated by the Income Tax Act, and this will be a tax paid to SARS. Therefore, guys, remember this will be an outflow of future economic benefits as we will have to pay SARS. Compared to deferred tax is only an accounting disclosure. This results due to a timing difference on our assets and liabilities, and this will not have a direct effect on our current tax. Therefore, this is due to a timing difference that will result in a temporary difference. Remember, and this will only be an accounting entry on the face of our statement of financial position. How do we calculate our deferred tax? First, we need to determine what is our carrying amount based on our accounting rules. Then calculate our tax base. The carrying amount minus the tax base will result in a temporary difference times our tax rate, and this will then be a deferred tax asset or liability. Now, there's a few rules that you need to study. The first rule is how to calculate your tax base of an asset. Remember, guys, the tax base of your asset will be the amount that will be deductible, a minus sign, against any future taxable economic benefit, and the arrow means future. Therefore, the amount that will be deductible in future. The second rule that you need to study is the tax base of a liability. Therefore, your tax base of your liability will be the carrying amount minus the amount that will be deductible against any taxable economic benefits in future. And then we need to know our tax base of our revenue received in advance. And this will be our carrying amount minus the amount that will not be deductible in future. Now, guys, important to identify the differences. When we have a look at our tax base of an asset, it's the amount that will be deductible in future. Tax base of a liability will be our carrying amount minus the amount that will be deductible in future. And then when we look at our tax base of revenue received in advance, this will be the carrying amount minus the amount that will not be deductible in future. You need to study these rules. When you attempt any IAS 12 question, write them down and apply them. Now let's have a look at the difference between taxable and deductible temporary differences. This will be rule number 4 and rule number 5 that you need to study. A taxable temporary difference is what the word indicates to us. Taxable, therefore we will have to pay. If we need to pay, we will need to recognize a liability. Therefore, this will be a deferred tax liability. When the carrying amount of your asset exceeds the tax base of your asset, or when the carrying amount of your liability is less than the tax base of your liability, we need to recognize a deferred tax liability. Now, let's quickly have a look at an example. If the carrying amount of my machine is 100,000, my tax base of this machine will be 80,000. My temporary difference will be 20,000. Therefore, my deferred tax will be an asset or a liability, guys. Let's have a look. The carrying amount of my asset exceeds the tax base of my asset. Therefore, if the carrying amount exceeds the tax base, this will result in a deferred tax liability to recognize. How do we recognize a deferred tax liability? We will have to debit our deferred tax in our profit and loss and credit our deferred tax liability in our statement of financial position. Now let's have a look at another example. If we have an accrual of, let's say, 80,000, remember this is a liability, the tax base of this accrual is 100,000. Our temporary difference will be 20,000. Is this a deferred tax asset or liability? The carrying amount of the liability is less than the tax base. Therefore, this will be a deferred tax liability. Let's have a look at the following category, a deductible temporary difference. Now remember, a deductible temporary difference will result in a deferred tax asset. Remember, deductible temporary difference. Therefore, if there is a deductible temporary difference against our future economic benefits, this will result in an asset to our entity. Now, if we have an asset and the carrying amount of our asset is 80,000, the tax base of our asset is 100,000, therefore our temporary difference will be 20,000. Will this be a deferred tax asset or liability? The carrying amount of our asset is less than the tax base of our asset, therefore we recognize a deferred tax asset. How do we recognize a deferred tax asset? We debit deferred tax asset in our statement of financial position and we credit our deferred tax in our profit and loss. Now guys, very important, we may only recognize a deferred tax asset when it is probable that there will be future economic benefits to be used against this deferred tax asset. Let's have a look at our next set of rules. Exemptions. And this you will find in paragraph 15 and paragraph 24 of IAS 12. Remember that land and admin building will be exempt. This is the rules followed by UNISA. Now, what does it mean if it's exempt? When you calculate your deferred tax, you will have your carrying amount, your tax base, your temporary difference, and your deferred tax. If the carrying amount of your land is 100,000, this initial recognition, remember initial recognition is the actual date that we've purchased the land. The initial recognition will be exempt from deferred tax. There will be no deferred tax, and in your UNISA exams you need to indicate it's exempt in terms of IAS 12 paragraph 15. But in this example, let's include a revaluation surplus. If our land has been revalued and there's a revaluation surplus of 50,000, what about this 50,000? Will this be exempt? No. Remember, the revaluation will occur in terms of IAS 16 and this will be subsequent measurement. Remember, this will be initial measurement and this will be subsequent measurement. Subsequent measurement will be tax. Therefore, our tax base will be 0. Why will the tax base be 0? Remember, the revaluation surplus is in terms of our accounting rules. Therefore, our temporary difference will be 50,000. Now, guys, important. IAS 12 indicates to us that when there is a revaluation surplus on land, we deem this capital nature. If this is capital nature, you need to tax this at 80% times 28%. Therefore, when you refer back to our first example included in our taxable profit, you will remember we've indicated that we will only tax 80% of this. We need to take out the 20%. And therefore, guys, remember 80% at CGT. The same principle with our admin building. Therefore, you need to remember that your admin building will include a depreciation. And that depreciation you need to include as an exempt difference when you calculate your taxable profit. Then goodwill. Remember, we will not recognize a deferred tax liability on goodwill, and this is what IAS 12 indicates to us. Therefore, this is a rule that you need to study. And you need to remember that if there is no economic benefits to be taxable, that your tax base will equal your carrying amount. Now, when you attempt any question on IAS 12, I want you to open this revision sheet and view this sheet. Apply the principles, guys. Therefore, you need to have your revision sheet as well as your templates that I've provided you on Core Campus. And thirdly, you need to have your actual IAS 12 available. When you attempt any question, you need to ensure that you work through your principles and that you need to study these principles for your test and your exam. Thanks for watching.